Hey guys, I'm David Mitchell, founder and CEO of TRADEway. What if God himself gave you a blueprint for how to handle your money? Well, the Bible is a practical book. Let's dive in and see what it has to say about wealth, about risk, about leverage, and about investing, and uncover how trading in the stock market can be a powerful tool for moving towards your biggest goals. We're so happy you're here. This is The Word on Investing. Hey guys, welcome back to our podcast. You know, if you check out our last episode, we talked about 4 kinds of world events that can affect your stock trading. And today I want to talk about 3 more. All right, so let's talk about wars or hurricanes or just bad events in general that happen somewhere in the world. How would that affect the U.S. stock market and your particular stock play? Well, you know I'm speaking in general terms, and the past does not always repeat itself in the future, but probability math tells us that we can observe patterns in the past, all different kinds of patterns, whether they have to do with the stocks or an index moving up and down, or whether it has to do with news and what usually happens when certain news events take place. And there is a certain probability that those things can repeat themselves. So it's worth looking at. Let's talk about wars. And this will surprise you about the U.S. stock market. You can have a war break out somewhere in the world, and as long as it doesn't involve U.S. troops, our stock market will just go up and be all happy the next day. It doesn't even affect it. And that's kind of good to know, because when you're a good trader, you think it will. You're seeing it in the news and you just think it's terrible. And you think the stock market should go down at least for 2 or 3 days, and it just doesn't do it. So keep that in mind. Now, if it's some kind of war that could affect us and cause our troops to have to go in, then at the point when that's announced, then the market could take a hit for 2 or 3 days, but it doesn't mean it's going to start a bear market. All right. Now, what about things that happen like hurricanes and they destroy huge amounts of a particular part of our country? Well, those don't generally affect the whole market. Like the S&P index could certainly continue an uptrend through a hurricane, but it can affect individual stocks. Like, what would you think it might do to a building supply company or something like that? I mean, you could kind of see how their stock might move up after a major hurricane. What do you think it might do to insurance companies? Well, if it's bad enough hurricane or a bad enough natural event, it could certainly cause those kinds of stocks to move down. So I would just say use common sense on those kinds of things. The main thing to understand is that if it's not happening on U.S. soil, a lot of times it just doesn't affect our market in a negative way, no matter how bad the event is. And that's kind of sad to think about, but that's how Wall Street is. All right, so let's talk about another one. How about the pandemic? We just had one, didn't we? What if we have another one? Well, we learned some things from this one. In my lifetime, we've never traded through a pandemic. So that was a learning experience for our family and for all of our TRADEway students. And the thing is, we sort of saw this thing coming, and we announced through the market alerts. Now, let me remind you, if you go out to TRADEway.com, you can sign up for Insider Plus, and you're going to get a lot of benefit from that. It touches on all 3 legs of the trading table: fundamentals, technicals, market tone. But you're also going to get a stock basket with about 100 of the best growth stocks in the world that you can choose from on any given day to do your trades. But the thing I was going to mention, though, is the market alerts that are part of the Insider program. And you're going to get emails, at least 1 email per day, that talks about how these news events are affecting the stock market. And that is so good to have when things like this happen. So when the pandemic began, we started getting wind of it, and we knew it was in China. We started getting the idea that it was in Italy, and then all of a sudden Seattle, right? Well, as soon as it hit Seattle, we let our students know around the country that they needed to go to cash, especially if they were in long-term investments. But even if they were in short-term trades, it was best to go ahead and take your profits and go to cash. And of course, those are always suggestions. We don't tell you what to do. We just give you suggestions based on our experience. And so it was really nice because we had our students out of the market. If you go back to the last episode, you'll see how you can look at an S&P chart and find it falling down through the 10-day, 20-day, and 50-day moving average. it had fallen below the 20-day moving average, and we had all this bad news coming out all of a sudden, and we recognized this thing could be really bad. So that's about where we said exit. So the market fell about 34 more percentage points after we said go to cash. So that's a lot of money that TRADEway clients had the ability to save by not being in that down move if they were in up play. So that's pretty cool. So that is nice access. So remember the Insider Plus program out there at TRADEway.com where you can get that sort of information every day coming to you. You could also sign up for a Step 1 Start Your Journey, which is a live virtual event that we do every so often, and you can do it from the comfort of your own home. It's a full 2-day event. It's the groundwork for everything you'll ever do in your stock trading career, and you can even sign up for Trader Max, which will get you a Step 2 ticket, which shows you how to do options. That's how you really leverage your money. It can make every dollar worth $7 to $14, and for short-term trading, options are the way to go. So think about Trader Max. It's a great concept, great lessons, including some coaching, and you get a ticket to a Step 1 and a Step 2 virtual events and extra coaching and all kinds of cool things. Just check it out. It'll show you every little detail. All right, so now when the pandemic happened, in the early days of it, we were letting the students know you might want to go to cash. Sure enough, we went into a bear market crash, and that crash fell a little bit over 35%. Now, what was interesting about it, that most of the big boys on Wall Street and also we at TRADEway, the normal bear market lasts 6 to 9 months, right? Well, this thing was over in a month, and it made a bottom. Everybody called it a V, and it just went right back up. Well, that fooled 90% of the big boy, probably 98% of the fund managers and hedge fund managers out there and us, because I've always seen it make at least a double bottom, usually a triple bottom before the next bull starts. So one thing we learned on a pandemic like this that was so bad and looked like it was going to affect the economy in a terrible way, and it really did certain quarters of the economy, like mom and pop restaurants or small retail stores, things like that. It decimated that part of the economy. But there were so many tech companies that do everything online that actually did so well that helped the entire economy recover pretty quickly, but certainly it made the stock market recover almost immediately. And we didn't see that coming. And so we missed some of that next up move. We weren't in the market because we kept expecting it to make another leg down and make at least a double bottom. And I'm sure many, many others did as well. A lot of the people that manage retirement money, they missed it too. And so people made very little money when there was potential there to make a lot of money, but everybody was afraid to jump in, and should have been, because statistically, that thing should not have been able to move up with a V. It should have made a W, in other words, a double bottom. So maybe that's something we learn, and yet the next pandemic may not react that way. And so the thing to watch is how well are the companies doing that can do business online, where people can do things from home, and that can prop up the whole market. It certainly did this time, at least for now, right? So that was pretty cool. Now, let me say this. The main thing to learn when you see a pandemic, or if you're getting the market alerts from TRADEway and we see a pandemic coming, is you definitely need to think about exiting the market. The biggest mistake that your old financial advisor that you may have had in the past, or you may still have now, the biggest mistake they make is they will leave your money in the market all the way to the bottom. That turned out pretty good this time because it was a 1-month bear market, which I have never seen in my life. They usually last 6 to 9 months, and sometimes it takes 15 years after a bear market crash, such in the year 2000, for your money to come back. The NASDAQ, for example, took 15 years to come back to where the high that it was at before it crashed in 2000. So if you're 70 years old, you don't want to wait 15 years to start making money again. So you need to make sure that you tell your financial advisor, listen, go to cash. Don't leave my money in the stock market when you see a bear market crash coming, whether it's from a pandemic or whatever. Exit the market, go to cash, and then when the thing is over and you see the next new bull market start, usually you'll see a triple bottom or a double bottom, and then it'll start. you can then re-enter the market when the stocks are way at the bottom. The stock prices are really low, and you can get a lot more shares for your money and then ride that back up, and you doubled your money comparing that to your neighbor who stayed in all the way to the bottom, you see. So that's something to think about. Now, I don't know when you'll listen to this, but we're right before the election. How could that affect a market? Well, it's interesting. You can use some common sense to sort of figure that out, probably. But let's just look at some history. Let's go all the way back, maybe at least 7 or 8 presidents back. And I'm going to go right prior to 1977. And we did our own study on this, so it's kind of interesting to use an S&P chart and see what it does before and after certain elections. So right before 1977 is when Jimmy Carter was elected. So before him, you had Nixon and then Ford, and which are obviously Republicans. And a lot of times Republicans tend to cut taxes, cut regulation, help the big companies do better and make more profits, and even medium-sized companies do better. And of course, the medium-sized and smaller companies are the ones that hire the most people. So it helps the jobs go up and unemployment go down, and usually helps the economy as a whole. So if you keep that in mind. Now, the Democratic Party, even going back to the Carter days, they weren't quite as socialistic as they are now, but they've always kind of been more raise taxes, take money from the rich, give it to the poor sort of concept. Socialism is kind of based on that. And so just the fact that they tend to raise the corporate tax rates can affect the entire market in a negative way. So let's just take a look and see how that's played out the last 7 or 8 presidents. So with Nixon and Ford, there was a big up move in the market prior to Carter, a big bull market, went up for 2 years. And then when Jimmy Carter was elected in 1977, being a Democrat who is going to raise taxes, who's going to bring in some socialistic concepts that are not good for business and jobs, then all of a sudden the market went absolutely flat for 3 whole years. It didn't go up or down, it just moved sideways. It didn't make any progress. Now, the last half of 1980, well, really towards the end of 1980, it began to move up. And guess who was starting to announce that he would run for president? Ronald Reagan, right? So that was starting to get in the news, and people were beginning to think he could win. And the market actually started moving up because he's going to cut taxes, right? He's going to cut taxes. He's going to cut regulations, make things work better for big businesses so they can hire more people and unemployment goes down, et cetera, et cetera. Sure enough, when Ronald Reagan was elected in 1980, the market remained flat for about 1.5 years, and then it just took off. And that's about the amount of time it took for his policies and the tax cuts and everything to actually make an effect on the economy, and then it just took off. So from 1982 all the way through 1988 was a huge bull market. Okay, so let's keep going. 1988, George Bush Sr. was elected, okay, and we had a bull market during those 4 years, an uptrend in the S&P. Then in 1992, Bill Clinton was elected, who's a Democrat. So from 1992 to 94, the market just sort of went mostly sideways with a slight move up. And then in 1995, during the end of his presidency from 95 to 2000, it was a really good bull market. So you ask yourself, why did that happen when you had a Democrat who's supposed to be socialist and raising taxes and taking from the rich, give to the poor, make things hard on businesses? Well, because Bill Clinton was a Democrat who didn't do that. Bill Clinton was pro-business, and he didn't raise taxes. And so that's the main thing you're looking for, not what party they ran on, is are they a person who's going to raise taxes on the corporate world and on individuals and add regulations that make it hard for business to make profits and so forth. So Clinton was sort of a mix there, but really I would say in his presidency, the market did really well. And then you had George Bush Jr., not really what he's called, but the younger, was elected in 2000. From 2000 to 2002, we had a really good bull market, but guess what happened in 2000? right about early in 2002, we had the tech bubble burst. And so the whole market tanked. We had a really big bear market, and it really kind of started a little bit before 2002, but it crashed, and that lasted a little over a year, that bear market did, and that's the one that took 15 years for the NASDAQ to recover, and it was a bad one. I mean, it was a big bear market, but that was not caused by normal economic issues such as taxes and so forth. It was caused by people driving up new tech companies up and up and up when they weren't even making a profit yet. And it became too speculative, and it created what we call a bubble. And that bubble burst, and it created a huge bear market crash. But then towards the end of his presidency, once that was over, you had a really good bull market from 2003 all the way to 2008 because he did lower taxes and so forth. And then Barack Obama was elected in 2008, and we had the Great Recession in 2008, and the market tanked. And then from 2000, and that lasted about a year, from 2009 to 2013, we had a little bit of a bull market during his presidency. And then towards the end, actually the last 2 years from 2014 to 2016, the higher taxes, the higher corporate taxes began to have a really bad effect, and the market made no progress for 2 entire years. And in our market alerts, we called it a flat bear market. The market made no further progress for 2 entire years, and that was because of the higher taxes. Now, what about when Donald Trump was elected? It's really interesting to go back to 2016, because the night before the election, no one thought he would win, right? And the market, the futures on the market went down over 500 points the night of the election. No one thought he would win. By the next Monday morning, the market was up 400 points the next day. Now, I'm talking about the Dow. The Dow tanked 500 points the night of the election, and then when Donald Trump was elected, it went up 400 points. Now, when futures go down, it doesn't really mean the market went down. It just means they thought it would, but that's because they didn't think Donald Trump would win. They thought that we would have a socialistic president who would raise taxes, Hillary Clinton, and so it tanked 500 points, but it didn't really mean the market went down, because the market doesn't move till the market opens the next day. Well, when it opened on Monday, by then they knew Donald Trump was elected, and it actually went up. It never went down. It went up. And you know what's interesting? It went up ever since. So his entire first 4 years, we had one of the greatest bull markets in recorded history. Why? Because the first thing he did was he cut taxes, and he cut a lot of the regulations on big business so they could hire more people. He cut taxes on mid-sized businesses, small businesses, which hire the most people. And so the unemployment went lower than it's ever been in my lifetime, and more people had jobs, and more people had good jobs because of his policies. So you can use common sense. Doesn't mean you have to be a Republican, of course. You can be a Democrat, but you still need to know that if a Republican's elected, the market is going to like that because the taxes will be lower and business will do better. It's just common sense. So keep that in mind. It'll really help your stock trading, because you can somewhat predict what may happen over the next, say, 2 or 3 years. Now, that's not going to help you so much on your short-term trading, although it would have when Donald Trump was elected, because you could have jumped right in a brand new bull market right there. And we certainly advised our clients to jump in that market, and we assume many of them did. And it was a great bull market, and still is 4 years later. So those things are somewhat predictable, not down to the short-term trading, like to the month or the week, but certainly where you have a general understanding of the broad market and where it's probably going to head over the next 2 to 4 years. So that's important. That's what we call market tone, by the way. And if you go back to previous episodes, we have 3 legs on the trading table: fundamental analysis, which means you need to know if it's a good company. And technical analysis is where you look at the charting, see what the trends are with this company. And market tone is, how does the news affect it? So this has to do with market tone when you're talking about these world events and how that can affect your trades. So remember, you can go out to TRADEway.com and sign up for Insider Plus, and it includes so many great things, information on fundamental analysis, technical analysis, and market tone, because you get market alerts every day that tell you what's going on in the news, in the world, and how that's going to affect your trades. But even better than that, you get the A-plus list, which has usually around 100 of the best growth companies in the world, and those are the right kind to do short-term trading with. So many great benefits to the Insider Plus. Or you could sign up for a Step 1 Start Your Journey, which is a full-blown live 2-day virtual event you can do from the comfort of your home, and it's fantastic. It'll be the groundwork for everything you ever do in the stock market. Or you could sign up for Trader Max, which will get you a Step 2 ticket as well, and you start to learn how to leverage every dollar through using options. It's really powerful. So think about those things, and we hope that'll be a great help to you. All right, well, I hope you enjoyed this show, and if you did, why don't you rate and review it for us, and that way other like-minded people can find us, and have a great day.